You're buying? Yes.
I'm sorry to interrupt. Just a quick question about the non-solicitation
Mm-hmm.
clause. So you were saying like if there's 3 employees and they all decide to leave and go open up a separate business, and if they're successful in that business,
Mm-hmm.
can they be made, like let's say they make enough money where if they are sued, they can pay whatever it is. Can they be made to shut down their business, or can they continue to operate?
Well, if you can, first of all, if you have a contract on your side, that really helps because it makes it easy. The judge can just read the contract and say, did you sign this? And the answer is, unless it's unconscionable, and you try to draft the contract so that it's not unconscionable, meaning that there's limitations on the non-solicitation, like if for a year or 2 years or whatever it is. So, you make sure it's not unconscionable when you draft it. But assuming it's not unconscionable and they stole your trade secrets in direct violation of the contract, then yes, you can sue them for stealing whatever that they've stolen, and you can bankrupt the company with the judgment that you receive, and you can get a restraining order stopping them from doing that as well if it's really bad. If you don't have a contract that gives you any of those rights, it's going to be a lot harder. It's really going to be a he said, she said, where they're going to be like, I'm the one who thought of that trade secret. That's not a trade secret. I knew that. Or even better, I've got every right to do that. I'm the one who thought of it. Why can't I do that? And we can make the argument that it's just inherently wrong, or it's tortious interference with a profitable business relationship. We can sue with for a lot of different things, but it can be really challenging. In fact, I had a case that I worked on, which was a total emergency, where somebody was basically a very well-recognized contractor who was absolutely fearless because she was rich and very well-respected, and she was just like, I'm untouchable. And to a large degree, that was true. Like, everybody was afraid of her, and nobody wanted to bring her to justice. But what ended up happening was she took she took a contract for, she learned about millions of dollars in contracts. Then she just called up all of the clients and she said, just go ahead and break your contracts. Don't worry about it. My attorney will take care of any lawsuits that happen. In the meantime, she lured everybody by saying, I'm going to give you all kinds of benefits and value-added things you're not getting from your current company. I'm going to introduce you to the most important people in the industry. I'm going to get you leads that are going to make your whole career. I'm going to do this, I'm going to do that. So what happens is, like, most of the people left, they were like, that sounds great to me. I'm going to go and do that. And so, we had to go into court and be like, she has a contract. It specifically says she won't do A, B, C, D, E, and F, but she's just fearless and she could not care less. And she's like, I'm just not afraid of the law. I'm not afraid of the courts. I'm just going to go ahead and do it. And so we were successfully able to get a restraining order. The judge, typically judges don't like restraining people in violation of the First Amendment. But in this case, she was so fearless about it that I was able to walk in and say to the judge, look at what she's doing. Look at what she's saying. This is complete disregard for any legal obligation she has. And the judge was just like, wow, this is really something. And she didn't even show up in court because she could not even be bothered to show up in court. And so, but still, it's very hard to get a restraining order, even if the person doesn't show up. And so, we did get a restraining order, and then she had to go and write to the clients and say, because these wicked, evil people went to court and got a restraining order against me, I can't continue doing what I promised to do right now because it's going to put me in violation of a state Supreme Court order. But don't worry, I'm going to try and get this taken care of, and then we'll be back to business again. And then she ended up taking it to federal court from state, and they vacated the order, and she was back to business doing just the same thing. And eventually it settled, but bottom line is that you've got to be as careful as you can. And if there weren't all of these contracts already in place, then this person would have been invincible. It was only the fact that all of these contracts existed that gave us any kind of leverage to even get that restraining order to begin with. So, anyway, point being that, they say that maybe 10 to 15% of the people out there are psychopaths, and that's true, or sociopaths, whatever they call it. And that's really true. There's a lot of people who are very charismatic and very friendly and very charming, but they're fully planning to rob you as soon as they can do it. And so, you just really have to be on guard as much as you possibly can, because again, like, a lot of these people are truly fearless. They don't even care what's in the contract. You're going to need to use your contract to stop them from what they otherwise will be fearless to do. Okay, loans and lines of credit. You've got to be very careful with loans. This is probably not the first time you've heard this, but loans are expensive. If you ever look at what's called an amortization table for a loan that, and you can pull this up online, for a loan that you're planning to take, it'll tell you what you're going to pay. If you only pay the minimum back on it, a lot of times you're going to end up paying double or triple the amount that you borrowed. It's quite shocking. So for example, you may borrow, I don't know, $150,000. And if you look at the amortization table, the way it's structured, you're paying almost all interest at the beginning. So say it's a 5-year loan or a 10-year loan, and you say, oh great, I have an SBA loan. This is just fantastic. It's at a good rate, whatever it is. Okay, if you need the money, yeah, it's great that you got it, but you got to understand, maybe you're going to make a payment of $1,500 the first month. $1,400 of that may go to interest, and $100 may be going to principal. So say you decide you want to pay it off 2 years later, they're going to be like, you owe $89,000. And you're going to say, how could it be? I made so many $1,500 payments. How could I still owe $89,000? And they're going to say, well, the way that this is structured is first you pay all the interest, then you pay all the principal. So if you held the loan for the full 10 years, at the end you would be paying only principal, but at the beginning you pay only interest. So not only on a $100,000 loan, $150,000 loan, might you be paying $250,000 or $300,000 over the term of the loan, but it's structured in such a way that if you're able to pay it off early, you're going to lose a lot of your benefit. So this is completely acceptable in the world of banking. This is just absolutely standard. So bottom line is you really need to be careful. Like, banks love throwing at you business lines of credit and SBA loans and building loans and all these other things. And if you're experienced and you know what you're doing, you're taking an expensive bridge loan because you've been in construction for a while and you know what it's going to be worth, you're partnered with someone who knows what buildings are worth, then fine. I have a lot of clients who take expensive bridge loans and they make a fortune, but they know what they're doing. If you don't know what you're doing and you take one of these big loans to buy a business or a franchise or whatever it is, that, along with your rent, is going to make it impossible to make a profit, or it could make it impossible to make a profit even if you are in a situation where you're making good money from sales. You still could just find it impossible to pay your bills. Now, something you need to also be careful about is the right of offset. This is something that kills people, that no one knows about for whatever the reason is most people take loans from the same bank that they keep their life savings in because they have a relationship with that bank. There's something called offset. That means that if you default on your loan that you have to the bank by not making a payment or two or whatever it is, they can offset their losses by taking any other money that you have with the bank. Now, you got to remember, there's that acceleration clause. That's not just for commercial leases, that's also for loans. So if you have a $300,000 loan and you miss a payment or two, then the full $300,000 becomes due. So if you've got, say, $45,000, and that's your life savings for your business, you've got in your account, you're just going to see it vanish, gone. You're going to go, it's going to say zero. And you call up the bank, what happened? Oh, we offset. And even if you file a bankruptcy, even the bankruptcy is not going to take that back because they have a super right to offset. And they're going to do that before you even file. So you're just going to lose your money. And people call me up hysterical crying, and they're like, I'm homeless now. I had money, I had plenty of money before, now I'm homeless. The bank took everything from me. I missed a few payments, they took everything. I don't know what to tell you. You're going to have to go to a counselor, get benefits, figure something out. We'll file bankruptcy to get rid of your debt. As soon as people come to me in a bankruptcy situation, the first thing I'll say to them is, do you keep your money in the same bank that you have a loan from? And if the answer is yes and you're in default, you better put your money elsewhere, or the bank is going to offset, and you could end up being tragically sorry. So if you learn nothing else from this whole speech, just knowing that offset exists could make it worth your time in spades. All right. See what we got next here. Venture capital and angel financing. We also talked a little bit about that. I don't have much more to add to what I already said, other than to just make sure you really understand your VC deal or your angel deal or any of those things, because it's not structured to satisfy you. There's a lot of people who have had these beautiful exits, and then you see them working at some job, making like $100,000 a year, whatever it is, and you're like, but I don't understand. Like, you had a $20 million exit, you had a $30 million exit. How are you, just working as a CPA at a CPA firm? Why aren't you in skiing somewhere? And they're like, how much of that exit money do you think that I saw? I'm like, how much? They'll be like, I'm like, how? They'll say, well, I did not understand what I was signing. The venture capitalist got every dime of it. There was just nothing left for me. And a lot of times the reason why is because they'll be like, your rights don't start until we have a $50 million exit. So if there's like a beautiful $25 million exit, you might not qualify for anything because you have not hit the goal. Like, it's a painful loss for the venture capital firm. I mean, not really, I'm being sarcastic here, because they would not have put their money with you if they thought they were only going to exit at 25 million. They thought you were going to be the next photo bucket or the next Facebook, and you badly failed them. So as a result, you may just see zero, because all of their shares need to be redeemed before your shares, because they've got preferred shares of stock and you've got common shares, and they have agreements that they can redeem for more shares and all of these things. So that's such a common story, that people exit for tens of millions of dollars and don't get anything for themselves. Again, if you've got a good business, it doesn't have to be that way, but you have to recognize what's going on. And typically, they'll have you work with their lawyers. They're going to be like, oh, you work with our firm, just like real estate brokers. And that lawyer does not have an interest in educating you appropriately about what you're dealing with, because they're making so much money in referrals from that VC firm. So you may not hear this from anyone else except for Bradley Balin. Like half the things that I'm saying here, you may not hear from anyone except Bradley Balin, but it's a good thing that you're here, because now you know. Online marketing agreements, people lose their shirt in marketing. Marketing looks so sexy. They have a way of making it look like it's a sure thing. And a lot of the time, it's fraud. And you just lose your money, but still you owe it under the contract. And I'm going to give you an example. When I ran a pretty large company, and I was interviewing people as full-time marketing manager, and someone who interviewed with me, he was in charge of marketing for a major, major magazine. And I was like, so what did you do for the magazine? And he's like, well, my job was to buy the cheapest garbage traffic by advertising online and drive it all to the magazine. So the way that it would work is they get an advertiser, say, who wants to advertise at top dollar, because this is a very respectable online publication. And so they'll make like $100,000, $150,000 purchase, which will guarantee them a certain number of views, 10,000 views, 15,000 views, whatever it is. Okay, so he's like, we don't naturally have that many views. Now we have to go out and deliver that many views. So we need to run all of these ads that just say, like, click here to enter a contest for a free steak, or whatever it is that we need to do, or like something that just tricks them and just redirects their browser to the site. Basically, he's like, my job is to drive huge amounts of traffic to satisfy these large orders from major publications. And I was like, so someone thinks that they're buying, that they're advertising to like, I don't know what, to 10,000 New York Times readers. And again, this was not the New York Times that was doing this, but it was the equivalent of that. And so they think they're spending a lot of money to reach this very affluent, educated group of people. And meanwhile, the publication is sitting there like just advertising on, I don't even know where they're buying this traffic from, to satisfy the quota. And then they're sending the person the bill for $150,000 and be like, done. So it's totally foreseeable that a lot of other, not just foreseeable, it happens all the time. I have a lot of bankruptcy clients who are in marketing, come to me for bankruptcy who are in marketing. And they're playing all of these games and they end up going bankrupt when their fraud is discovered. And a lot of times they're downline. They don't even realize that the person above them is using fraudulent technology because they're buying the traffic from someone who's buying the traffic from someone who's buying the traffic from someone who's getting it from a black box. And no one knows where the traffic is originating except for a dude in Russia. And at the end of the day, someone figures out that they're being defrauded because they're just not making any sales. And it turns into a mess. But meanwhile, some small business owner ends up having spent $100,000 on this advertising, and now they're totally broke, or $10,000, or whatever the case may be. And there's so many similar examples of this kind of thing. So again, if you don't understand what you're doing, start small. Do a small purchase, and if it goes well and you know what you're doing, do a little bit bigger purchase and a little bit bigger purchase. Don't just go for broke and just go all in on anything, no matter what it is or who it is, because it's not going to work out the way that you intended. Another example, this is something I want you to know. This is something which is very common, is small business owners run into large companies like, I like what you sell and I want to buy it. I want to put it in all of my stores because it's a great product. And maybe it is, but a lot of times these larger companies, they systematically go bankrupt. For a lot of small companies and individuals, you feel like going bankrupt is a terrible thing to do. It's the last thing that you want to do. It's your worst nightmare to go bankrupt. But for larger companies, this is absolutely par for the course. It's just a way to take huge risks and get rid of all of your debt at the end of the day. It's absolutely standard. And so for a lot of these companies, what they need to do is just find people who don't realize that they went bankrupt a few years ago and that they're ready to go bankrupt again. And so they'll, for example, you might be a manufacturer of Jiminy crickets, and they're really good. So they'll call you and be like, we need 75,000 Jiminy crickets for Toys R Us. And you say, all right, great. And you go take a loan to make, we have net 120-day payment terms, net 180-day payment terms, meaning you deliver the Jiminy's now, and they're going to pay you in 180 days for everything they were able to sell. We're going to put them in a great shelf in a great location. The last toy manufacturer who worked with us, they sold so many. Okay, wonderful. Then we know what happened to Toys R Us. Well, maybe we don't all know, but they just went bankrupt. So everyone they owe money to, kaput. That's it. They're not paying that money. So, so that's how that works. And a lot of small businesses that come to me for bankruptcy, they literally have done nothing wrong. They've been in business for generations and generations. And usually what ends up happening is the kids took over from the mother and father, and the kids just haven't seen this before. And so the mother and father are out there retired or doing whatever it is that they're doing, and the kids don't realize. And so the company will be like, can you send us more? Can you send us more? The CFO is on vacation right now. We've got that big check for you. It's just, we just got a new CFO. Whatever the excuse is, they're just putting you off so they can keep making revenue while they're getting their bankruptcy in order. And a lot of times people don't realize it until it's too late. Then they call me hysterical and they're like, they've got everything. Like Toys R Us called us, or National Wholesale Liquidators called us. We just figured, they're like a Fortune 500. What could ever go wrong? They're a big company. And we just got a notice of bankruptcy. You're now bankrupt too. I hope you don't owe people too much money. I'd hate to see the same thing happen to them. But anyway, bottom line is be aware of it and understand that if someone has something, if someone likes something that you have the right to demand stronger payment terms. If it's going to be costing you a lot of money. You have every right to say, I cannot give you net 180, or at least not for an order of that size. There's a whole art to assessing how much credit you should give someone, and I would love to teach a class on that. But bottom line of it is, you need to be careful. If you're not otherwise capable of researching who you're giving the credit to, then you can just say, listen, you can't build up a debt of more than $10,000 or $15,000. You know, like, I'll give you net 60 or net 90, but I can't let you place more orders until you take care of the money you already owe. Now understand, these larger companies, they don't need to do net 180. A million times I've seen them pay the next day. All they do is they just get permission from the right manager to have the accounting department cut the check now because they want to do it. They tell you, you know, we have strict policies, you know, we're a publicly traded company, we have to stick to very strict routines. The reality is they don't need to stick to any routines. The only routine they need to stick to is documenting what they did and why they did it. But beyond that, they're totally capable of making a payment early, of agreeing to different payment terms if that's what they want to do. And, you know, if you've got a great Jiminy Cricket and they need it, you have every right to say, I need you to, you know, put down $30,000 ahead of time to help with the manufacturing costs. I need, you know, whatever it is you need, you can fully negotiate with them. And if they want what you're selling, it absolutely will work and they will agree. And at a minimum, they'll say, okay, maybe instead of net 180, we can do net 90. And I say, okay, fine, if you can live with that, net 90 and you know, not more than I can't give you more than $15,000 in credit. So if they're selling well, I'm going to need you to start paying faster so that I can send you the next shipment. And believe me, if you're selling well, they'll rush that money to you. They'll give you an advance. They'll do whatever they need to do because they're selling well. A big company is no different than a small company. It's just that they have a lot of prestige factor, and so sometimes you just don't realize that, and you give them more negotiating power than they really should have. One other piece of advice that I want to give that will help get you out of trouble is they have something called Know Your Customer. It's mandatory for banks. It's not mandatory for non-financial institutions, but boy, is it helpful. These Know Your Customer checklists and stuff like that. Basically what it involves is systematically using common sense to evaluate what is the likelihood that this is going to be a successful transaction versus a fraudulent transaction. And you know, there's all these things in the checklist you can look at, but one of those things, for example, is this the kind of business that would typically do business with a business like my own? You know, so for example, say, you know, Goldman Sachs calls me and they say, Bradley, we want you to be our lead counsel. We want you to supervise all 10,000 lawyers who work for us. Will you accept our offer? What should I be thinking, right? You're going to be thinking, really? Me? You know, I mean, this is what you typically, you know, this is typically what you'd hire, you know, a 10,000 person law firm for that. You wouldn't hire a solo practitioner. So if someone calls with something like that, what do you expect? You expect that it's fraud, that they have nothing to do with Goldman Sachs or whoever it is, that it's literally just some kind of a fraud or something that they're saying is incorrect. Maybe they're a contractor for them and it's not really the company, but they're a contractor. And so they want me to provide the legal services and then they're going to get paid by the client and then they're never going to pay me. This happens with government contracts all the time and so on and so forth. So it's fraud. I don't know how it's fraud because I need to go through the Know Your Customer list and go through the checklist. But once I do that, I'm going to figure out that it's fraud because it just doesn't ring true. It just doesn't make sense. So, and most of the time that's how you're going to catch fraud is just by people making you promises that don't make any sense or that sound too good to be true. If it sounds too good to be true, it always is. We talked about franchise agreements. You know, we talked a bit about buying a business. Okay, so now say things begin to get tight for whatever the reason is. What are you actually going to do when things get tight? Your options can be continuing to run the business on loans from banks, family, or friends, getting a new business partner or a lender who's going to give you cash, slimming down your operations, selling more, collecting your receivables faster, or putting the business in bankruptcy. Those are going to be what your options are, and you can do some of them or all of them, depending on what your circumstance is, one after the next after the next. But the one thing that you want to be careful of is just don't be in denial of what your situation is, because denial is going to take away all your options. Okay. Now, one of the first mistakes that people make when they're starting a business is not having excellent control over their finances. What does that mean? When you take all these courses on starting a business or business plan, they tell you, you need to have all of these fancy budgets, and it helps. It helps. The more meticulous you are, the better. But the reality is that QuickBooks is hard to use. Bookkeepers are expensive. Budgeting takes a lot of time and it's boring. And there's a million reasons why you won't do it. But what you do need to do is 1% of what everybody tells you need to do. Basically, you just need to write down what money you took in, and you can just do this in Excel, like just what you took in and where it came from and what you spent, at least the large expenditures, and what you spent it on. That can be like in a week, that could be 6 lines in Excel, that's it. Just like, I sold 30 bottles of vodka, I sold 45 bottles of beer, whatever that you sold. I paid the vodka distributor this much money. I paid the beer distributor this much money. I paid this much for rent, and so on and so forth. And the reason that you need to do that is because otherwise you're not going to know what's happening with your business. Because what happens is, say you get close to the end of the year, everybody wants their tax write-offs. They want to advance their expenses. And so you're going to have a lot of people paying early. And you might feel like you're on top of the world because all of a sudden, like, I've never seen this much money in my life as is currently in my bank account, and spend more and be like, good, now I can buy more inventory and all these other things. Then the next month, no one pays because they all paid early, or for the next 2 months. And now you actually can't pay the rent. You can't pay your loans. Sales have dropped because everybody's broke in January and because they spent all the money during Christmas season. And now you're like, oh my goodness, well, I can't even stay in business anymore. And so now, if you knew what that trend looked like, just by having this basic information written, then you would know what happened. You'd be able to look at it and say, why did my numbers go like that? They went like that because a bunch of people paid early. So in December, you're going to know you're not doing as well as you think you're doing. And in January, you're going to know you're not doing as bad as you think you're doing. You're going to be able to average everything out and know what's going on. Plus, you're going to remember things like the insurance premium is due twice a year, and you have to spread out the insurance premium. So when you look at what your expenses were over the past 6 months, you're like, oh, right. I can't feel too rich because I'm going to have to pay the insurance again in 2 months. And there might be a client who didn't pay you. And one of the worst things that happens to companies is not knowing who's paid and how much they paid. And it seems like it can never happen, but it happens all the time. Someone comes in and they just give you $1,000 for whatever it is. You put it in your pocket and you're busy making sales and you just forget about it. And they're going to be like, oh, I paid you all $4,000. And you're like, I don't think you did you? And you're looking and you just don't have the records. You're like, where could the records be? Tell me I wrote this down, please. Don't tell me I have no idea. And you just don't have it written down. They're going to be like, no, remember, I came in on January 1st. I gave you $2,000. Then 3 months later, I came in and I gave you the difference. I don't forget things like this. I write everything down. Here's where I gave you the first $2,000. Here's where I gave you the second $2,000. And if you don't have it written down, then you're going to be in trouble because you're just not even going to know. So it's so helpful to just have these rough notes written down. Like, I got $2,000 from John Doe and nothing else. Because you try to get everything into QuickBooks, you're going to end up having nothing in QuickBooks because it's just too much. It's too confusing. When you're larger and you can afford a bookkeeper, you'll do it. But when you're first getting started, just do a little bit at a time. Just do something rather than nothing. One time they were interviewing Arnold Schwarzenegger, and he was saying, it was very inspirational, He was basically saying, don't tell me that you can't be big because you don't need to look like Arnold Schwarzenegger. The way you become me is you do one push-up. At least I believe that was what he said. He said, don't tell me you can't do anything. He's like, get on the floor, do one push-up, if that's what you can do. There's a huge difference between 1 and 0. Once you're there, you just might do 2 because you're there. And if you're that motivated, eventually you may look like me, but it doesn't start looking like me. It starts with one single push-up, with one single sit-up, and you don't need a gym for that. You don't need weights for that. All you need is a floor and 2 hands is all you need to do push-ups. So there's no excuse not to be doing it. So, so that's the bottom line with that. All right, income. Yes.
Sorry, I just have a question about income tax return.
Yeah.
So, like the last company I worked for, our fiscal year didn't start until April 1st.
Mm-hmm.
Like your fiscal year, does that matter in terms of filing your taxes? Is it easier to start your fiscal year closer to like April 15th, or is it better to just do from January to December in terms of just filing taxes?
All right, well, I can't say anything authoritative because I'm not a CPA, but I've almost never seen a fiscal year other than January through December because there's just no good reason to do that. And larger corporations do it all the time.
Yeah.
But for a small business, it just adds confusion because except for the city of New York, everybody uses a fiscal year of January to December. New York City starts in July, but everyone else orders, does January to December. So it's like, why would you just be different than everyone else? And
I never understood why we did April 1st to like March 30th, like that was our fiscal year.
There's reasons why, but with a tiny business,
Yeah.
I can't think of any good reason why.
Okay.
Okay, so now if you're ever going to need help with your finances, because you're going to take a loan or you're going to work with a consultant or anything like that, there's some things you're just going to need. You're going to need a profit and loss statement. You're going to need income tax returns for the past 2 years, copies of your leases. This is just a list of the basic things that you need to do any kind of financial analysis. And it matches very closely if you're going to file bankruptcy with what you need if you file bankruptcy. This is what you have to bring to the bankruptcy court so you can explain to the trustee why it is that you can't pay any of your creditors. Or many of your creditors. So understand these are important documents, and everyone has a copy of the packet. So you've got a list of everything that's here, or at least you should. It's helpful to have a budget. It's helpful to have a business plan. All of these things are helpful if it's realistic and it makes sense to you, and at least you've been in business a little while and you understand what you're trying to do. If it's just an exercise in raw fiction, then it doesn't do anything for you. It's better to just have a few weeks of records of what you spent in the past, and based on that, just make a budget for 1 week or 2 weeks or a month or whatever it is, just so you know if you're going to go out of business at the end of the month or not. I mean, literally, I'm not trying to be funny about that. It really helps. Like a lot of times it's helpful to just look back at the past month and make a budget just for the next week or 2 weeks or the next month, so you have an understanding of whether you can pay your employees or whether you should let go of everyone now so that you have enough money to pay the rent or start making people part-time or whatever the case may be. How do you get employees and creditors on board? All right, a lot of times you need to just talk to people about getting rid of debt. And one of the easiest ways to do that is just to have an honest discussion with people about the fact that you just can't pay it. And they'll be cooperative. So usually you want, and this includes employees too, when you're telling people you're not going to be able to give them their vacation, you're going to need to cut their salary, that all these different things are going to happen. You need to be friendly but firm, and you want to show people that you're treating everyone fairly. A lot of companies, they'll come and they don't need to file bankruptcy. They just need to go out of business and not pay anyone they owe money to, which they can do if there's no personal guarantees, but they just don't want to end up with litigation. And so one of the purposes of business bankruptcy is just to show that everyone's being treated fairly, to show transparency. But that's not just an issue with bankruptcy, that's an issue with all of employment, is that you want to show that everybody's being treated fairly. When people feel that they're being treated unfairly, that's where all of your problems come from. That's where complaints to government agencies come from. That's where lawsuits come from. That's just where all problems originate, is people feeling that lack of transparency. So, you need to go to the employee, to go to your vendors and just say to them, listen, I'm paying everybody 10 cents on the dollar, and that's all I can do. If I don't have agreement from most people, then I'm going to have to pay zero. So, you tell me I don't have more. I'll give you a copy of my financials so you can see what the company has left. And I'll give you a list of who I owe the money to if you want. And that's it. I can pay 10 cents on the dollar. I've got 10,000 left in my account. And that's what I'm going to do. Now, if someone's like, well, you should pay personally, say, well, I'm not going to do that. I don't have a legal obligation to do that, and I'm not going to do that. What I have to distribute is the money I've got left in the account. And if you've got nothing, you can just turn around and listen. I just want to say I'm sorry. Maybe if you want to say it face to face or whatever. So I thought things were going to go better. They did not go well. The company is completely bust. I'm not going to be able to pay you. If you want to sue, I can't stop you from doing that, but the company's bankrupt and you're not going to get any money at the end of the day. It's just going to be a waste of your time. But I'm going to start another company, and when I do, I'm going to do business with you again. We'll do it on better terms. If possible, let's not end on bad terms, because I think there's a lot more for all of us. And when you do that, a lot of times people, they're not happy. They're like, all right, let me think about it. This is hard. But usually they'll come back and say, I understand. I'm not happy. And if you come into more money, please pay me. But I understand. Thank you for being strong about it and looking me in the eye and telling me what's going on, rather than hiding. Because it's that lack of transparency that makes people, feel bad. So, and same thing with employees. When you say I'm lowering everyone's salary. And by the way, when you pay people, it's really better to pay all the employees the same amount of money. Or if there's going to be a difference, have it be for a very clear reason what the difference is, because everybody loves talking about their salary. And so if you end up having different pay for different people, everyone's going to hate your guts. Everyone's going to be filing complaints with the government. You'll find it so much easier to just say, like, a customer service job pays $45,000 plus certain benefits, if that's what it is. And everybody who starts here starts at the same amount of money, and you're eligible for up to a 5% raise after 12 months on the job if your reviews are whatever they are. But it really has to be as standard as you can possibly make it, because everybody talks and everybody's looking for a reason to feel they're not being treated fairly. So if you're going to have a successful business, you need to go through contortions to show that you're being fair, to have objective standards for everything that you do. So when someone says I wasn't treated fairly, you have to say, and by the way, if there's a government charge, that's literally what the government will say to you, is they're going to say, well, what is your criteria? Let's just see if everyone is treated by the same criteria. And if you don't have written criteria, they're going to be like, so it's what you feel like. It's not based on anything objective. It's what you feel like. And if the answer is yes, you're really in trouble. You want to be like, no, this is the criteria for a raise. This is the criteria for a promotion. This is the criteria for overtime. And we stick to that criteria rigidly. This person came late 5 times. Every time someone comes late, we put a letter in the file and we speak to them. Here's the 5 letters. Here's the notes from each of those conversations that we had. This person was fired on an absolutely objective basis. You come late 5 times, you get fired. That's our rule. And everyone who comes late gets the same treatment. And, so that really helps. So in terms of options, so I'm going to move a little faster here, because what I already talked about is really the point of what I wanted to communicate. The rest of these things are not so relevant at this point. So we're going to just zoom through it. Options to restructure and refinance debt, or any of these things: debt consolidation plans, debt consolidation loans, credit counseling, bankruptcy, all of these things. Now, I'm just going to go through bankruptcy very, very quickly. I'm going to do a 5-minute overview of bankruptcy. Basically, what bankruptcy does is it allows you to get rid of some or all of your debt. It's say, I don't have enough money left to pay my creditors. I'm broke. I need all of my debts gone. You can have a debate about whether that's right, wrong, ethical, unethical, but it sure works. And it's a great thing to know about. And a lot of times you're going to take major risks. And if it doesn't work out, that's how you're going to be getting rid of your debt, is by filing bankruptcy. It should be part of your exit strategy. You should understand it. Basically, there's 2 types of bankruptcy you can do. There's personal bankruptcy and there's business bankruptcy. Unless you take personal liability on your business contracts, you are not liable to pay your creditors on a business contract. So in other words, any contract where you sign it as CEO of the business, not personally, if the business runs out of money, the business does not need to pay those debts. The only exception to that rule, other than having taken personal liability, is if the business was not operating properly. Like if you were treating it as your personal piggy bank, if you were not observing the corporate formalities, if you're not treating it like a company, if you're just treating it like your personal bank account. So if you never took the company seriously, the government's not going to take the company seriously, and they're going to say it's not a real company. But as long as you observe the basic corporate formalities that you need to observe, and you have enough money in the company, and you don't put all your personal expenses on the company's account, then you can just walk away from your company, and the creditors are going to get stuck for all of the debt, and they'll get whatever assets you might have, but that's it. So like if you have a commercial lease for $400,000 and you can't pay it, and only the company's name is on the lease, then, which some landlords will do because you gave them enough security or they were desperate, whatever the case may be, then done. You walk away, you're done. You don't need to file bankruptcy. They say a business bankruptcy is almost like a fancy funeral. You don't need to do it, but you can do it just to show everyone that you're being fair. So if your business is doing really well, you can pay some of your debt, but not all of your debt, by doing what's known as a Chapter 11. I'm not going to get into what it is, but basically if you want to keep your business running and you're making good money, and I mean good money, but you just have too much debt, then you can get rid of a lot of it by doing a Chapter 11, which lets you get rid of and restructure a lot of your debt. Personally, a lot of people who come to me for bankruptcy, they come personally because they signed documents guaranteeing the commercial lease, or they put everything on their company credit card. Most people can file personal bankruptcy and get rid of all of that liability still. It doesn't help your credit in the short term, but boy, does it work. And depending on the size of your family, you can make a lot of money and have a pretty decent amount of money in your bank account and still get rid of all of your debt, especially if you go out of business and you don't have another job, so you have no source of income. You can get rid of a lot of debt. I don't remember offhand what the numbers are, but it's something like if you're one person, you can make like $50,000 or $60,000 a year. You can have, if you own a home, you can have up to $170,000 in mortgage on, in equity in the home, and you're still okay to file bankruptcy, so almost everyone who owns a home can file bankruptcy. The home won't stop them in that regard, because when you add $170,000 to your mortgage, it's going to be more than your house is worth. So most people are considered to have zero equity in their home. So if your income is not particularly high and you don't have a large amount of savings, you can just wipe out your debt. And the cool thing about this is you can wipe out lawsuit debt. So for example, I had someone call me, and he was an ATM installer, and I guess he bungled a lot of contracts, and he received a lot of money, which he had since spent. And so he was getting sued for many hundreds of thousands of dollars, because apparently installing an ATM is a very costly thing to do. I don't know, $80,000, $50,000, I don't know why, but it's expensive. So he was hired to do many of them. He bungled all the jobs. He was getting sued for hundreds of thousands of dollars. He's like, I can't pay this. I spent the money. I can't do anything with this. So he just needed to file bankruptcy, and that'll just get rid of the lawsuit. You don't have to pay a lawyer to deal with the lawsuit. You just file bankruptcy, and all liabilities disappear, with the exception of liability for things that are considered evil. Like, for example, if you stole money from someone, you can't file bankruptcy on that. If you have liability for a drunk driving accident, you can't file bankruptcy on that. If you went nuts with your credit card a week before filing bankruptcy with the intent to not pay for what you charged, you'll have to pay for that. Things that are considered just corrupt, they'll leave you with. But anything which is just honestly a ton of debt that you can't pay back, like those SBA loans, you can go bankrupt on those SBA loans and get rid of them. And a lot of times, for a lot of people, there's nothing wrong with their ability to make money in business. They just screwed up a lot of things because it was their first go-around. And the relationships they have are still good. The knowledge they have is still good. The technical skills they have are still good. They just need to get rid of that SBA loan and that credit card debt and that commercial lease liability and all these other things. And so they'll do that by just filing bankruptcy and then starting another company. And so you should not be afraid of bankruptcy. You should understand it and understand your rights, because a lot of those people who make millions and hundreds of millions and billions, filing bankruptcy is very much a part of their business model. They take enormous risks with the understanding that they'll file bankruptcy if they need to and get rid of a lot of that stuff. So I warned you about other people doing that to you. You need to understand that you're going to have that option as well. You just have to be careful that if you have a lot of money in your own name, that you need to put that in some form of a trust or do something with it before you go taking personal liabilities and making personal guarantees, because otherwise it could stop you from filing bankruptcy if you have too much money in the bank. But and again, personally, if you are making good money, you can also reduce your debt down to what you could afford to pay, which is usually a pretty good reduction, by doing a Chapter 13. It's the personal equivalent of a Chapter 11. Basically, it's where you say, listen, I make money. I'm not eligible to pay my creditors nothing, but I need to pay a lot less money than I currently owe. So, you can do that. And a lot of times you end up paying pennies on the dollar, even when you're earning well over $100,000 a year, as long as your expenses justify it. And really, the bankruptcy system is very generous, and it's not, you don't need to be vagrant to file bankruptcy. You just need to be less successful than the average person. I mean, that's pretty much where they get the standard from, is what does the average person make? So if you're in worse shape than the average person, then typically you can file bankruptcy. And most people that I meet are in worse shape than the average person. I don't know where they get the average person who has so much money, but usually when people need to file bankruptcy, we're just fine in terms of the income requirement. So in your packet, you've got all these examples of Chapter 7, Chapter 13, Chapter 11. I'm not going to go through those now. You're welcome to call me and I'll answer any questions, or email me. I'll answer any questions that you have about it. If anyone has any questions, please feel free to ask now. The presentation is finished. Questions? No questions? I bored everybody to death. All right, so we're all set then. If anyone wants to give their commentary on how you felt I did for the camera, if you're willing to be on camera, please feel free to do that. If not, you will not be on camera for any reason whatsoever. You have my personal guarantee about that. It's only pointed at me, and we're all set. Thank you for coming.